You're listening to the Goldnomics podcast, with new episodes every month on iTunes and YouTube. Subscribe today to stay informed.
Welcome to episode 1 of the Goldnomics podcast, where we're going to take an in-depth look at global economics through the lens of precious metals. I'm Dave Russell, and alongside me today I've got CEO of GoldCore, Stephen Flood.
Hey, Dave.
And Director of Research and well-known precious metals commentator, Mark O'Byrne.
Hello, Dave.
Right, gents, congratulations on your first podcast, the first Goldnomics podcast. And you already have a very large following that's interested in your message about precious metals. And this is really going to be an opportunity for you to get that message and your view on global economics out to a wider audience. What's the purpose for you of the Goldnomics podcast?
I think it's a great opportunity to kind of touch on major themes happening in the markets today, conversations we're having with our clients, the major motivations, concerns, anxieties that are out there, and viewpoints on the opportunities that we see and are presented to us every day through our clients.
Mm-hmm. Right, cool. Mark, you must see this as an opportunity to bring balance and insight to a wider audience. What are you looking to achieve by this podcast?
Yeah, very much to inform, enlighten people about what's happening in the wider markets and the world of finance and money, the murkier world of finance and money. There's a lot of uncertainties, there's a lot of potential variables out there, and yet I think there's a very high degree of complacency. So if we can bring a little bit more, I suppose, understanding of some of these risks that are building in the system again, I think that would be the number one aim of the podcast.
Right. Okay. Now we're going to be focusing primarily on the outlook for precious metals and for the global macroeconomic environment in 2018, but we really need to have a few words in relation to 2017. I mean, it's been such a remarkable year. A year in which financial markets have kind of shrugged off whatever risks have been out there from a geopolitical point of view, from a macroeconomic point of view. I mean, what have been the real main themes of 2017 that have stuck out for you guys?
Yeah, it's been a fascinating year. I don't think anybody last year or maybe a year and a half ago could have predicted where we are today. The markets looked even kind of somewhat toppy back then. They'd had an incredible run, and then with the election of President Trump in the United States, we're seeing a massive change in the world in terms of it's becoming, less unipolar and more multipolar. There's a lot more people operating in the market. Geopolitically, there's a lot of hotspots in the world, and there's jostling for positions in various different areas, and so I think for me, Donald Trump being elected has really shocked a lot of people, a lot of liberals, and I think we're seeing the massive change in that regard, and countries around the world taking a lead again in their own interests and where they're going.
Right. Okay. Yeah, Mark, what are you seeing as a major theme for 2017? What stuck out for you?
Yeah, I mean, there's so many things, and there's so many things going on. It's hard to keep up with on a daily basis, and every day it's just you wake up and you look at the Twitter machine and what Trump has tweeted overnight, and just so many developments. Politically, on the geopolitical side, as Stephen said, in terms of the election of Trump and the things that he's doing internationally in terms of foreign policy and also domestically, obviously, we saw the tax reform that he managed to get through and surprised many people to get that through there last week. But I think it's never been, there's always uncertainty, but it seems to me that there was a level of uncertainty in 2017 that was very, very high. But even despite the North Korea thing, I mean, I think the North Korean threat is somewhat exaggerated, but it was a real concern for people, and yet markets just kept trundling along and kept going higher and higher all the time. Yeah,
that's what I was going to say. It's like, despite all these risks that we're seeing in the markets, or globally, we're seeing financial markets just shrug it off and march ever higher.
Yeah, absolutely, and that's people are scratching their heads, including ourselves, because I think we felt that these markets were toppy a year ago. So at the same time, it's interesting when we look back. I mean, the company was founded in 2003. When you look back at the period 2006, 2007, 2008, there were similar. There was huge imbalances building up in the system, and there's a lot of geopolitical uncertainty as well in terms of. Bush was in power at the time, and obviously there was the war in Iraq and Afghanistan, and there was terrorism. And meanwhile, the debt levels in the world were growing all the time, and the US debt position, and indeed both the public sector debt and the private sector debt was increasing all the time, and these imbalances were building up. But people were saying, "Oh well, everything will be fine. There's nothing to worry about." And then obviously 2007, 2008, we got into the global financial crisis. So, the complacency can continue, and it's all based on cheap money, as we know. They've just printed so much money and they flooded the system with money, and there's a huge amount of liquidity in there, and we've nearly 0% interest rates. And I think that's what's maintaining the confidence. It isn't any, it isn't any rudely or robust economic growth or that's driving the exuberance we see in financial markets. It is very much to do with cheap money and near 0% interest rates.
And then looking forward to 2018, what are the themes that are going to carry through? What are the things we're going to really have to look out for in 2018?
Well, I think more of the same, but I think at some stage we are going to see a sharp correction in the marketplace. I mean, it's very unusual what we've seen in terms of just consecutive record highs in stock markets and bond markets over a long period of time in recent months, and yeah, we will see a sharp correction at some stage, and that tends to be the nature markets. Is that you get periods when there's huge risk appetite, and then you get risk aversion. We haven't had risk aversion for a long period of time. I think when that happens, the question is when that's when gold will come into its own again as a hedging instrument, a safe haven asset. So I mean that's one thing, because the everything bubble, as the phrase has been coined. I'm not sure about who. We think it's possibly a guy called Jesse Felder, who's a Bear Stearns hedge fund guy. But I think it's great. It really captures the essence of these markets.
That refers to exactly
the basically stocks, bonds, most stock market indices around the world are at all-time record highs now. I think we're on the verge of 100 trillion as the total capitalization of global stock markets. Bloomberg had an article yesterday. It was something like 99,873,000,000 reasons to be worried about 2018. So they're alluding to the fact that the global stock market total capitalization is 100 trillion. Bond market is 50 trillion. The total capitalization of the gold and silver market is only 3 trillion.
And so historically, this is not something that we see, or traditionally, this is not something that we see. Bond markets, equity markets, property markets, all going higher.
It's very unusual. Very unusual, and stock market capitalization alone are way higher than they were in 1999-2000, which subsequently we realised we had a stock market bubble, not just in the Nasdaq, but the S&P 500 fell very sharply. And again in 2007, 2008, when the S&P 500, the leading US stock market indices, benchmark indices, fell 50% in 2008. Today, the scale of the bubbles is much, much bigger than it was then. So, yeah.
And all made them more remarkable on the back of the increasing geopolitical tensions and macroeconomic risks.
Absolutely, yeah. And there's a few reasons we might have time to go into why that's happening. It's partly because obviously 0% interest rates is a huge thing to do with the psychology. There's more greed than fear in terms of the stock markets and people trying to get a return. They're not getting a yield on their bonds. But I think it's also the algos, and this is something Stephen has spoken about before as well. The machines, a lot of
algorithmic trading.
Yeah, trading. It's all about momentum, and if the price
computer
keeps going
black
up,
boxes.
In effect, yeah, and they're all about the trend and the momentum, and if the trend is up, it tends to feed itself,
Okay, so these are traditionally trades that historically would have been processed and put on by human traders, now being put on by computers, and just going with the momentum of the market.
In effect, yeah, pretty much. Yeah,
okay.
So it's an important consideration as well, and it means that. That's what's one of the factors creating the bubble, but it creates a huge risk on the downside subsequently, when the market turns.
Steve, just bring you in here on this point as well. Yeah. The key influencing factors for 2018 from your point of view.
Yeah, an extension of what Mark was saying there. I mean, like when you throw that amount of liquidity at a global capital market, a lot of unintended consequences can happen. And
where's this liquidity coming from?
Well, it's central banks basically printing money, and they will go to market and buy junky assets off, banks and investment houses, and they will pay them 100 cents on the dollar and get a junky asset, which they'll put on their balance sheet, which might be only worth 10 cents on the dollar. And now they're thinking that by putting that money in with the investment house then invests it. It trickles down into the rest of the economy. It helps little people, and the economy ticks away. But what's happening is that by printing this money, they are devaluing the money that's in all of our pockets, our savings accounts, our pensions. And there is some upside.
Is this what we're people would know as quantitative easing?
Yeah, this is quantitative easing. This is the printing of money. This is the reflation of the economy, and they're forcing the economy into a growth cycle. But they're also turning away from the fundamentals. They are stopping the market from pricing risk, because they're active in the markets for bonds and for debt and for investments themselves. And so they're setting the price for debt, they're setting the price for risk. And so the markets, and many aspects of the markets, they have withdrawn, and they're no longer participating in many of these markets. The markets are, the biggest player in these markets is the official sector. And you see situations in Japan where something like 2/3 of their domestic ETF market is actually government owned. I mean, that's a complete and utter perversion of capitalism. And so if you're an investor trying to play in that game, you're always going to be just found out, or you can't actually play it on the basis of fundamentals or analysis. You have to decide what's going to happen at the central bank board meeting, and then play on that basis. So I think if you look at those two aspects, there's the pricing of debt and the pricing of risk. On that side, we're completely blind, and then the pricing of return and where should you put your money. And on that side, we're pretty blind as well. And you can see that with the march of the major stock market indices. No matter what's happening at the top echelons of global leadership, or the massive lack of cohesion in Brexit talks, or in various parts of the world, or with the issues within European Union and cohesion, and provinces were looking to separate away. I mean, these would have been major market events in times past, but no longer that's no longer the case. So I think the markets are running blind. It's because of the official sector, but also passive indexers are also very active in the market, more and more so, because people can't invest on an active basis, or don't have as much faith in that process before picking a winner, avoiding a loser, and duking it out with the market. They're just abandoning traditional investment techniques, giving it over to a passive indexer who just will mindlessly follow the market. So you have the official sector who's buying up the market, you have the passive indexers who are buying up the market, and the traditional
passive index, now just so we get this right, a passive index, they're just going in there and they're buying all the stocks in an index rather than trying to pick the winners.
Exactly. So they're looking at the market as an efficient pricing mechanism, and so they're buying every stock that's there because it's listed, no matter whether it be a well-run company or not. So there's no real price discovery in their action, which there is a case for passive indexers. I mean, it makes sense to have that strategy in a portfolio, but when they become so big and so powerful, and then they're also you also have the effects of the official sector as well. Then it perverts the market itself, and that, I think, is where we are today. That's why we're seeing this relentless march higher, but ignoring fundamentals, ignoring leverage in the market, ignoring debts, consumer debt levels. It's just marching higher and higher.
But traditionally and historically, precious metals, and in particular gold, would have played that role as kind of canary in the coal mine. But over the last year, at least, if not longer, we've seen gold move sideways, silver move sideways, probably slightly down in all the major currencies. Has it lost its role as that canary in the coal mine, or what's really going on for gold and silver at this moment?
I wouldn't go quite that far, but it was up 10% roughly last year. It's in dollar terms, it was up roughly 10% this year. I think pretty much flat in euro sterling terms. So you would have expected it to react to some of these big geopolitical events that have happened, and we did get little short-term blips and rallies, but you would have expected that. But at the same time, gold tends to have an inverse correlation with stocks and bonds and risk assets. So the fact that these assets have kept going up, a lot of the institutional money in particular would say, well, we don't really need a hedge right now. It's quite the opposite, obviously, that the higher these markets go up, the more the need for this hedge, and they need to have this inverse correlation, this hedging instrument. But I think that's why we haven't seen a move into gold, because, you know, it's just huge complacency because these risk assets keep going higher. And it's based, it's based on massive amounts of debt. I mean, the imbalances that were there in 2007, 2008 led to the global financial crisis, the credit crisis, which was, credit crisis or a debt crisis. The amount of debt in the world then was 150 trillion. Today it's over 220 trillion. So it's 330% of global GDP is the amount of debt in the world. And today what's happening is, it used to be when we created a bit of debt, we would create maybe 2 times as much GDP growth. And then it was 1.5% GDP growth. Whereas today, we're actually creating less GDP growth with the amount of debt we're creating. And that's even with 0% interest rates, you know. So it's just the whole economy, both the public sector and the private sector, is absolutely saturated with debt. In effect, they're finding it hard to take any more debt, you know. And that's what makes all these risks that we're talking about, you know, they haven't created the impact on the markets that you would expect, but at some stage they will, and it will be I think will be a leverage impact, and I think you'll see, potentially a crash akin to what we saw in 2008, and that's when gold and silver will come into their own, and they should react as well.
And what do you think is going to be the banana skin for this bull market?
I mean, there's just so many variables. One I think that no one's talking about, or very few people are talking about, we covered it about 2 weeks ago, is the Italian banks. The Italian banks, just the non-performing loans, the scale of it's absolutely huge, you know, and that creates the risk of bail-ins.
How's that going to factor into the larger market then?
Well, it creates the risk of bail-ins, because that's now enshrined in the European legislation and indeed the global legislation, that your deposits are no longer safe. And rather than taking money from the taxpayer, if banks get into difficulty again, they're going to take money from the depositors. And if that happens, I think that will be a huge psychological moment. And I think it will really impact the economy in terms of consumer sentiment and purchasing. And I just think it will be very, very, very damaging, you know. But also how it impacts things is that Mario Draghi is already coming in under pressure from the Bundesbank and from more hawkish elements and the rise of these more conservative parties in Germany. And they're saying 9 to the QE, no more QE to Mario Draghi, the Italian central banker. If the Italian banks get into difficulty again, and it's not just Italian banks, it's the Greek banks, the Portuguese banks, the Spanish banks, you know, then the scale of the QE, he's doing, I think, roughly $1 trillion a year right now. The scale of the QE would have to potentially increase, and I'm not sure the Germans have the appetite for that, you know. So that has the risk then of creating contagion, where right now it's just completely crazy in terms of, you know, the market mechanism of pricing risk. The Italian, the Irish, the Spanish 10-year bonds are down near levels of the US 10-year treasury, and, you know, none of these bonds should be down at 1% and 2%. They should be at 5, 6, 7, 8, 9, 10% potentially.
Junk bonds too.
Junk bonds too, yeah. The entire credit market is just totally perverted.
Yeah. You know, developing markets and junk bonds, all of their debts, the yields have fallen massively. It's just there's a search for yield everywhere, and basically things are being picked up by investors, which would traditionally been rejected. But just looking ahead to 2018, I do think that what's been kind of coined populism is in fact a development that's based on monetary policy, and I think the middle classes. Okay. Yeah, I'm going to connect the dots here. So the middle classes have been increasingly squeezed over the last number of years. They have had to take on increasing debt loads in order to maintain standards of living. Their salaries have gone sideways. They're busier people. They have less personal time. Their net assets are falling in many cases, and this is creating a degree of anxiety in our Western countries, whereby they're looking for answers politically to their problems. And so, I mean, if you look at what's happened in the last number of years, I mean, you would never have predicted someone like Donald Trump would be elected president. You wouldn't have thought that someone who is as left-leaning as Jeremy Corbyn in the UK would literally take over the second largest party in that country. You wouldn't have thought Macron would have come to power and replaced a large portion of their entire parliament inside 1 year. You're looking at right-wing political parties in Poland, the rise of the right in Germany, a lot of discontentment out there. And I think that trend will continue. It's very difficult to say how it's going to manifest, but I think it will continue. And I think if you look at the central banks and their absolute urgent requirement to increase interest rates in order to have firepower to put out the next systemic crisis, I think when that happens, that population of middle class voters will feel even greater effects and greater financial discomfort, and will continue that search for answers. And I think we're going to have a lot of political turmoil, and therefore we won't have the capacity to manage opportunities, and we won't have the ability to manage risks as well.
This idea that central banks are raising rates just so they have room to cut rates further if they come under pressure. I mean, it's not like kind of hitting yourself on the head with a hammer just because you like the feeling of it when it stops.
Yeah, I mean, absolutely. Yeah. It's true, but it is one of their primary tools in the toolbox for them to have a quick impact on an economy that's getting out of alignment. So they want to create growth, or to spur on growth, or they want to stop runaway inflation. And so interest rates and the cost of money, is a very, very important way of doing that. They don't have anything in the toolbox right now other than, quantitative easing, which they can see. I mean, if you look at the central bank's balance sheets, they are in lockstep with the stock market. I mean, anybody can see that there's a massive, massive correlation between the two. And one feeds the other, and they see this, and it makes a mockery out of what they're supposed to be, and the free market and capitalism, and so it's almost a form of socialism is where we are right now, corporate socialism you might call it, and because there's corporatism, there's a certain element of society that is massively benefiting from this at the cost of even more people, and we're seeing that in terms of inequality, we're seeing that in terms of political voting patterns. And this is a problem that will continue to go on, and it all has its source with the political manipulation of money, and that is the blood of our economy, and it's been manipulated.
Yeah, no, I'd agree with all that, and I think it feeds into that. These central banks, I mean, it's I hate saying it because they're good people, they're not bad people per se, and I think most of them are probably decent individuals who want to see normal people do well, want to see the economy do well and all the rest. But they are the root cause of the problem in terms of their policies. Their monetary policies they created these financial crises in the first place, and now their reaction, they have actually managed to kick the can down the road and engendered quite a feeble recovery. But they're actually storing up a much, much bigger crisis by what they're doing. And Evan and Stephen said there is absolutely right. And
are they not limited in terms of their tools, though, that they have to control this?
Absolutely limited, yeah. And I think that they're reaching the end point. I think even they are beginning to realize that, especially because they haven't managed to. If we had a true economic recovery in recent months and years, interest rates would be much higher than they are now. Even with this recovery, we're still near 0%. And the Federal Reserve is obviously gone up by 25 basis points on a few occasions. Has taken up a small bit, but I think it actually feeds into another theme
of low inflation as well.
Yeah, everywhere except in the UK, and Brexit, yeah. But it feeds that whole central bank thing, creating this populism and creating this. It's everyone's it's polarization. Moves to the right, moves to the left, and it also feeds into another big theme in 2018. But it's a big theme that we've obviously been talking about now in recent months, which is the topic du jour of Bitcoin. And I think that financial discontent, a lot of the people who are buying Bitcoin are concerned about these risks, and they're worried about the central banks and the impact that it's going to have on the dollar and on the euro and the pound and on the banking system and the wider monetary system. I think obviously that's something everybody's talking about it right now, and it's very interesting, very sexy, and all the rest. And but I think that it's something we're going to be talking about for years to come. Not necessarily Bitcoin per se. I think Bitcoin is a part of the story, but just the whole cryptocurrencies and what's going to happen in that space, and indeed the blockchain itself, which is where the real value is.
Yeah, I mean, I think you've brought us into the whole Bitcoin conversation, and I think it's an important point, and I do think it's instructive of where we are as an investment community. The fact that something that has no tangible form is conceptual can become and take hold of the public psyche so fast, and it's attracting so much attention. I think it's very instructive in terms of the search for yield. The average punter has a very difficult time making just normal investments these days and getting a decent rate of return for the risk that he's taking. In the banks, they don't get any return really. In fact, it's negative when you take inflation into account. Where the banks will take that money, and usually they don't even want the money, they'll charge you for having it there, but they're able to then lend it out at 400 or 500 times the rate that that they're getting it at. Essentially near zero, and they're lending it out at 6-7%. So it's like a tax on productivity. So people are being left out of that. They're not participating in that. The banks are, and the big investment firms. So they're looking for yield, and anything that's moving in price attracts a disproportionate amount of attention. And Bitcoin is a beneficiary of that now. But, just in terms of, as Mark said there, the technology behind Bitcoin is really transformative for the future. It's, blockchain, it's distributed ledger, it's a protocol that is, made for a digital economy, whereas the standard protocols we have today, like the euro and other technologies, are very really kind of paper-based systems that have a digital kind of side to them that we've created, and they're very slow and inefficient. But Bitcoin and cryptographic currencies and distributed ledgers are designed for a digital world and bring enormous benefits to every sector of the economy and enormous disruption. And I think 2018 you're going to see a number of industries being turned over essentially, and having massive disruption and benefits, and also a little bit of pain as well for some of the incumbents there. But it's exciting times to watch, exciting times to be involved in any market. And I think anybody out there who's running a business or has a specialty needs to have a cryptographic currency or a cryptographic ledger based strategy and see how it affects their industry.
Right. Well, no, we don't have time today to go into Bitcoin in the detail that we probably need to in order to give it what it deserves. But that said, I mean, they say, I don't know who it was that said that markets can stay irrational for longer than you can stay solvent. But I mean, are we seeing just like a tulip bulb type mania in Bitcoin at the moment?
Yeah, I mean, Mark had a great tweet out the other day where he looked at the actual number of days it took for Bitcoin to hit like 1,000 mark benchmark prices, and it was dropping, all the time. It was really interesting to watch. I would never be so foolish as to put a top on Bitcoin or make a prediction as to whatever it's going to go. It'll go as high as someone's willing to buy it for. But I do think there's a lot of fundamental problems with it. It says more about the market that we're in at the moment and the effects of QE than it does say about how attractive Bitcoin is as an investment itself or as an asset class. It's absolutely a bubble. It's I don't think many people are actually using it as a currency in terms of daily transactions. Most people are hoarding it, and they want on the basis that they're going to see higher prices. Nothing wrong with that, have a punt and go for it. But I certainly wouldn't confuse its success with your own success personally and change the way you look at investments. This is probably, I mean, and I know I'm a bit cruel here, but it's a bit of a folly at this time, and I hope it doesn't damage the whole concept of cryptographic distributed ledgers or blockchain for the future.
Right, okay. Now, I suppose get back to what we're meant to be talking about here. The Goldnomics.
Hang on a second. I have to say something about Bitcoin.
Okay, all right. Okay.
Just briefly, because I think we need to give it, as you said, the time it deserves. But, I mean, as you said, so first of all, on the tulip thing, I mean, tulips are flowers, and they can be mass produced, whereas the value of Bitcoin is there's only ever going to be 21 million of them. So the inventor, Satoshi Nakamoto, I can never pronounce his name, but this individual or group of people were, when they set up this maths protocol, the production, it's very much mimicked. When you read the white paper, it's very much mimicked about how gold operates in terms of the gold standard, and the supply growth only increased about 1.52% per annum. So that's the value of it is that technology and the blockchain and the distributed ledger at the back end of it, and the peer-to-peer nature of it. The people who are really, you're talking about the discontent and the inequality, and people, young people and informed people, technologists are really saying, well, why do we pay banks 2-3% to send our money from one person to another person? Why do we have foreign exchange fees? If we want to send money, you've got Mexican immigrants in the States and they have to send money down to Mexico City. Why do they have to pay these huge fees, So there's a huge value in this technology. Bitcoin itself is going to hugely overvalued in the short term. But that's not to say, as you alluded to, become a lot more overvalued, you know, and that's the nature of bubbles. They just and the fact that everybody's talking about a bubble in Bitcoin strongly suggests to me it's not a bubble, because the psychology of bubbles is people throw in their hand and they say, oh, it's not a bubble, it's a new paradigm. But everybody is saying Bitcoin is a bubble. Therefore, I think the price will go a lot higher. But I would agree with Stephen. It's highly speculative. I don't think, if you're an investor, obviously you have to, if you have a significant appetite for risk, maybe buy a small bit of Bitcoin, a tiny amount of a portfolio. But otherwise, if you are in any way risk averse, a conservative investor, you should not be buying Bitcoin. I think for younger people, get familiar with the technology, or even slightly older people, I think it is the future. Some form of cryptocurrency is the future. Buy 0.0001 of a Bitcoin and just get familiar with it, you know, because we're going to have some form of cryptocurrency. It could be crypto gold, could be crypto silver, could be something like GoldCore launches. It could be state-backed cryptocurrencies, or it could be some of these private cryptocurrencies we have at the moment. Who knows? But it is the future, almost certainly, unless we get some massive event that impacts the growth that we're seeing in the whole technology space, you know, and a massive slowdown. As we saw after the Nasdaq bubble, the technologies that were being developed then, they only came to fruition in effect, you know, 5, 6, 7 years in terms of the e-commerce platforms and the social media platforms that we use today.
Yeah.
Okay.
Can I come in there? One more thing. I know
Go
you're
for it.
trying to move us on here, but absolutely, yeah. What Mark said there, I would agree in large part. What I'm waiting for is some sort of official representation of cryptographic currencies. And I think the governments of the world are never going to give up the power to print money or to control monetary policy by putting it in the hands of the many. So they're going to come out and they're probably going to come out with some sort of cryptographic currency that will be accepted around the world for certain
Venezuelans
transactions.
Already have.
Yeah, so I think
people were surprised that it was the Venezuelans of all people.
Yeah, exactly. Well, I mean, you know, because needs must, you know, and they had to do, and that's when some of the greatest innovations come by is from difficult periods of time. But I do think someone like the IMF will probably come out with some sort of cryptographic currency protocol that will be used at certain echelon within society, and then might come down to other sides. But it's absolutely disgraceful the actual transaction costs that are out there for the man in the street. So yeah, it is the future.
Right, okay. Want to drag this back now to what we're here to talk about, which is gold and silver, precious metals for 2018. Where do we see them going for the next 12 months? What's going to break this sideways trend that they've had for the last while?
Who knows? It's finger in the air stuff, isn't it? I mean, and there's just so many variables, and nobody knows ultimately. If we try not to get into the predictions game, we always are hesitant to say we think the price will go up, down, or sideways, because we just don't know ultimately. And we've been wrong, or I've been wrong in recent years. I've been bullish. Sorry, I was bullish on the price to go up last year, and it's going up in dollar terms this year, you know. But I don't think it's gone up as much as we thought it would do, and actually it went sideways, it went down, and it went sideways for longer than we thought it would, you know.
So what's the reason to continue to hold gold in 2018? And that's probably a better question.
All the risks that we said, you know. But gold is a store of value, unlike Bitcoin. I mean, the you know, Bitcoin evangelists and all these beliefs in Bitcoin, they keep saying gold is a store of value, but there's no evidence whatsoever Bitcoin is a store of value. It's only in existence for 9 years, you know, since 2009, you know. So whereas gold is a proven store of value throughout history, and also it's a hedging instrument and a safe haven asset, and all the academic research shows that. So independent PhD economists, that's what they say, as do the asset allocation experts. So if you look at pension experts around the world, including Mercer, they say having an allocation to gold in a portfolio is a very, very valuable thing to have. So I think the smart money is aware of the risks that are in the world, and I think they're beginning to allocate to gold, and you can see that to a degree in some of the figures in terms of the ETFs have been gradually rising the holdings in there. So, I mean, there's so many potential black swans and risks that will drive the demand into the gold market again, and who knows? I do think the Middle East is. I mean, my background is history, and I've been amazed that the Middle East has remained as stable as it has done in the last few years, given what's been happening. But I think when you see what's happening in Saudi Arabia now, the tensions with Iran are bubbling up again, and I think and then we see what Trump has done now with Jerusalem, and, you know, protests all over the world. I think the Malaysian foreign minister said something about sending an army into Jerusalem to defend it, and you're just going, so that to me is, but who knows? It may not be 2018, and that's the thing. These things take longer than we think to manifest themselves, So, and none of these risks may manifest themselves in 2018. It may be 2019, 2020, but I think at some stage some of these risks will come to pass, and that's when having the insurance that is gold will become very valuable again.
Steve, what's your reason to continue? Why you suggest that everybody continues to hold gold and or silver into 2018?
Well, I think it's very much financial insurance, and the nature of insurance is it shows up when you don't want it and when you didn't expect it. So you have it for those uncertain times, and so it's hard to put a time frame on when you're going to need gold. It's when will that risk manifest for you. So I think the underline, as Mark has said there, is very, very strong. Do you think that the world is going to be more stable in the future? Do you think the risk is less likely? If you do, then don't own gold. If you think that there's always a latent risk there that you need to be protected against for your family, for your own personal self, then you have to have an allocation of gold. The question is, how much do you need? I actually think 2018, 2019 and beyond, I think a big story will probably come out of Asia. I think China and the amount of people who are being lifted out of poverty there, and their love of gold over the centuries and millennia, arguably, will create an enormous amount of demand for gold, because they're at a point in time where their economy is at a point in time where they're going to have some cycles, and they're going to have down cycles and up cycles, and I think they're going to run for safe assets. The argument for safe assets is very strong. They're looking at where they are now. They're looking at slower growth rates, arguably more stable growth rates, but they're still going to look to allocate some of those newly found riches into gold. And I think that is a massive market factor for the future. I think in the West, we're looking at stock markets that are massively inflated. Whether we have a correction in Q1 or Q2 this year, I think there's a strong likelihood that we will. I just can't imagine this market going on much further at the same rate it's going. I think that we're going to have some major pullbacks at some point, and I think the argument for safe haven assets will be reasserted at that point. So I think 2018 could be a very exciting time for gold. We're getting this from our clients. They are allocating to it. They don't allocate on a short-term basis. They're allocating on the basis of long-term wealth preservation, and that fundamental point is very, very strong for gold. So that's where I think where it's going.
So going back to what we were talking about at the beginning of this podcast, when we're seeing that risks have been increasing geopolitically, macroeconomically over the last while, and the market has been ignoring them, but those risks are still there, even though the market has been ignoring them. And gold and silver have remained relatively stable in their price. So what you're saying is that the risks are increasing, but at this moment in time, the insurance against those risks, the price of that, i.e. the price of gold, hasn't increased yet. So it's still actually representing a good opportunity to get to have insurance in your portfolio.
At a very cost-effective price, exactly. At the time they buy insurances, before the accident happens, before you have the fire in the house, you have the car crash, you don't buy the insurance afterwards. So, and prices are very, still, very depressed. I mean, even the global cost of production is, when you talk about the, gold's intrinsic value. Gold has a value because it's very rare, very finite. It has a value in and of itself. It's like land or water or the air that we breathe. We live on a small, finite planet with 3 billion to 7 billion projections for 10 billion people, whereas all the gold in the world fit in the centre court of Wimbledon. It's 21 going on 22 meters cubed. So it's just, that's why it has a value. It will always have a value. And the gold that comes out of the ground costs roughly $1,100 to produce per ounce. That's the average cost of global gold mining production. So it means that there's actually, you're buying insurance, and plus, your insurance is not going to plummet in value. There's a floor there. That's not to say it could go lower in the short term, but it's not going to go hugely lower, because if it goes much lower, these gold mines go out of business. And then there's even less supply in the marketplace, which is even more bullish in the medium and long term. So it's a very, very low risk, and in terms of the risk with the reward, it's I mean, we would say that, wouldn't we? But I mean, when we live and breathe it, and so we know this inside out. But if anybody comes to this with an open mind and does the research on it, they'll come to the same conclusions.
Yeah, I mean, it's funny when I'm talking to clients, and I kind of laugh about this sometimes. I say, I hope you buy your allocation of gold today, and I actually hope you lose money on it. Because if that price, that's an allocation, it's a safe haven allocation, it's maybe less than 10% of your portfolio. The factors that are driving it down in price are also driving the other 90% of your portfolio up. And so net you're a winner. But in those very those rare but highly disruptive moments in the market where we have a massive disruption and things are falling and people are running around like their hair's on fire, that guy who owns gold or that lady who owns gold, they're not going to be rushing to hit the sell button as fast as somebody else because they've already taken a provision. They've got some sort of degree of balancing going on inside their portfolio. One element is going up where the others are maybe losing value, and so they're not panicking. So that's why you own gold. It's a great psychological boost for you in those times of great uncertainty.
Right, okay. So just to bring this to a close then, I'd like to get from you just one word or one phrase that is going to be the watchword for 2018 when it comes to macroeconomic, geopolitical, financial markets. What's the one key theme, one driver, one watchword for you for 2018? For me, I think it has to be continued uncertainty.
That's 2 words.
Well, okay. Well, you can let me. Okay. You can let me away with that. Okay. Yeah. What you got? You got 3, Mark. Go for it.
Everything bubble bursts.
Everything bubble bursts.
Yeah, I actually think it is, and it's dangerous. And who knows? It might be 2019. Momentum's a very powerful thing, and the momentum is just incredible. I mean, new record highs just in recent days in stock markets. Everything, whether it be London property market, that's beginning to top out. It's interesting. A lot of them are looking like they are topping out, but global property markets, stock markets, bond markets, art markets, vintage cars, everything is at all-time record highs. Bitcoin is going absolutely crazy. Gold and silver are cheap. So I think we're on the verge. No guarantees, but I think there's a very good chance that these bubbles will start to burst in 2018.
The everything bubble bursts. Okay, Steve.
Well, I think interest rates. For me, I know it's kind of boring, and I'd like to give you a really sexy one there, but it's just not. It's interest rates, and I think the interest rate policy of central banks is going to determine everything else. And they want to raise rates; they're going to do it. They're running out of reasons why they can't raise interest rates, so they're going to do it. And I think that have a knock-on effect, a domino effect on this massive reflation, this quantitative easing that's been going on, the thing that's driven up prices of every asset class, as Mark just described. So I think that's the one to watch, and a massive taper tantrum, so to speak.
Okay, so we've got continued uncertainty, we've got interest rates, and we've got the everything bubble bursts, and that's what we've got to look forward to for 2018. Thank you, gentlemen, and congratulations on the first of your Goldnomics podcasts. We're going to have another one same time next month. We'd like you to subscribe to our podcasts. You can see how to in the show notes underneath this, or subscribe to our YouTube channel. Follow us on Twitter. Like us on Facebook. But for now, from me, from Mark, and from Steve, it's a thank you and a very happy new year.
Thank you, everybody.
Thanks, guys. Happy New Year.
You're listening to the Goldnomics podcast with new episodes every month on iTunes and YouTube. Subscribe today to stay informed.